The world of finance is not static. It is a landscape in constant motion, shaped by technological leaps, global events, and evolving investor expectations. For decades, the industry operated on foundational theories that prioritized mathematical optimization of risk and return. However, a transformative approach is redefining success, shifting the focus from beating the market to fulfilling personal life ambitions. This philosophy represents a more human-centered future for wealth management, where portfolios are constructed not as abstract collections of assets, but as tailored engines designed to power specific dreams. The traditional cornerstone, modern portfolio theory, MPT, championed diversification as a fundamental principle. While its insights remain valuable, its limitations have become apparent. It often assumes a uniform rationality among investors that doesn't exist in reality, and its reliance on historical data can be a flawed compass for future navigation. Subsequent models attempted adjustments, but they largely stayed within the same paradigm of maximizing returns for a given level of statistical risk. The breakthrough comes from asking a different question entirely. Instead of, how do I optimize my risk-return profile, the pivotal question becomes, what do I want my money to do for me and my loved ones? This simple yet profound shift is the essence of the new methodology. This approach recognizes that investors are human, not purely rational actors. Our financial decisions are frequently clouded by cognitive biases. Loss aversion can make us sell solid investments during a temporary downturn, while recency bias can tempt us to chase yesterday's winning trend. The illusion of control might lead us to believe we can consistently time the market, and herd mentality can provoke impulsive decisions driven by fear or greed. A skilled advisor today must be part financial architect and part behavioral coach. By understanding these psychological traps, advisors can help clients stay disciplined, framing conversations around long-term objectives rather than short-term market noise. Clear, jargon-free communication using relatable analogies is key to building trust and ensuring clients remain anchored to their personal vision during periods of volatility. The tools available to build these purpose-driven portfolios are more diverse than ever. The long-running debate between active and passive investment management is increasingly seen as a false dichotomy. Passive investments, particularly exchange-traded funds, ETFs, provide efficient, low-cost building blocks for gaining broad market exposure. They democratized access to markets and remain core components. However, active management retains a crucial role, especially in less efficient market segments or for achieving specific tactical goals. The modern perspective is not about choosing one over the other, but about thoughtfully combining both. Furthermore, the toolkit has expanded to include alternative investments, such as private equity, real estate, or hedge funds, which can offer diversification benefits and potential returns that behave differently from traditional stocks and bonds. Simultaneously, the powerful rise of sustainable investing allows individuals to align their capital with their values, seeking financial returns while contributing to environmental or social objectives. Implementing this strategy begins with a deep, personal discovery process. It requires moving past vague desires for growth to define clear, tangible goals. Each goal has its own timeline, priority, and required funding amount. Saving for a child's college education in 10 years is fundamentally different from preserving capital for a comfortable retirement in 30, and both are distinct from setting aside funds for a dream vacation in 2 years. Each of these objectives carries a different risk budget. The portfolio is then constructed as a series of sub-portfolios, each aligned with a specific goal and its appropriate risk level. This structure provides immense psychological comfort. A market dip affecting long-term retirement funds doesn't necessarily derail the short-term vacation plan, which should be held in more stable assets. It transforms investing from a stressful exercise in tracking market benchmarks into a measurable journey toward personal milestones. For financial professionals, this evolution is not just an option, but an imperative for future relevance. The role of the advisor is expanding from asset allocator to holistic life planner. Clients now expect guidance that integrates investment management with tax planning, estate considerations, charitable giving, and lending strategies. Technology and automation will handle more of the routine analytical tasks, but the human ability to understand dreams, navigate emotions, and build trusted relationships is irreplaceable. The advisors who will thrive are those who embrace this comprehensive, goals-oriented framework, using all available tools, from ETFs and alternatives to behavioral coaching, to craft unique solutions. Ultimately, this philosophy empowers investors to see their wealth not as a scorecard, but as a resource for building a meaningful life, bringing clarity and confidence to the complex world of finance.